Hello Edexcel AQA students, we're gearing up for paper 3. In this video, let's look at key macro and micro effects of macro policy. You never know, this could be a major feature of your paper 3 essays this year. Just bear in mind guys that I've already done lots of micro and macro effects videos already. They're already on the channel in my revision for paper 3 playlist. Go and check those out. Also bear in mind all the key micro macro topics I've listed for you, and I've also covered major micro and macro effects generally so that you know what you need to write for these kind of essays. So make sure you check all those videos out and then also look at the new ones that I'm uploading too. Let's dive in then. Micro and macro effects of major macro policy. Well, let's start by looking at expansionary monetary policy. That could be via lower interest rates. That could be quantitative easing occurring in the economy. The macro effects are easy. It's a macro policy. That's normally how we revise it and learn it. Well, of course, we can go to higher growth. We can go to lower unemployment. As a demand side policy, these policies shifting aggregate demand to the right, seeing higher rates of short-term growth, lower rates of cyclical unemployment is a logical way to go. You might want to talk about rising inflation, maybe higher demand pull inflation, maybe fighting against deflation would be a relevant macro effect, of course it would. And then we can make a link to our current account position, how maybe via an increase in aggregate demand, exports become less competitive, lower export revenues worsening the current account deficit, but also with higher growth, with lower unemployment, higher incomes in the economy can mean more sucking in of imports, that effect taking place, more spending on imports, again, in theory, worsening our current account position. The other way you can go there, actually, is by going completely the opposite way, and how you could say, well, if interest rates are cut in the economy and that leads to a weaker exchange rate via hot money outflows from the economy, you could actually see a current account improvement. It's just about which effect dominates, and you can decide as a macro effect which way you want to go to the current account position. So the macro side is pretty simple. What about the micro side? Well, on the micro side, you can always worry about the impact on savers, how lower interest rates reduce rates of return on savings. So for those people who rely on their savings, look at pensioners, look at the early retired, look at the economically inactive, look at the unemployed, even just generally people who are trying to save up to buy a house, let's say, how lower interest rates erode returns on savings and reduce their living standards. You could think about the impact on the housing market. Lower interest rates make it cheaper to borrow money, to get a mortgage, to then buy a house, increasing the demand for housing, increasing house prices. Now that's good news for people who already have houses. It increases their wealth. But for those who are looking to buy a house, first-time buyers, maybe those on lower incomes, well, that's bad news for them. It makes it harder for them to access the housing market. For firms themselves, lower interest rates, if they've already got loans, variable interest rates on those loans, well, they're going to come down. It's going to lower a firm's cost of production. It's going to increase their profitability. There is that benefit to firms for sure. And for households who are heavily indebted already, lower interest rates, if those rates on their loans are variable, it's going to reduce their monthly repayments towards those loans and therefore increase their disposable income, increase their living standards. So you've got those micro effects there, focusing on individuals or on the housing market. What about on the contractionary monetary policy side? Well, essentially, this is just the reverse, right? But there are some unique elements you can bring in. So on the macro side, again, we're focusing on higher interest rates here. Again, you can go down the AD route to lower growth, to higher cyclical unemployment. You can talk about lower inflation. Absolutely, that would be a dominant macro effect as to why interest rates go up in the first place, to lower high rates of inflation in the economy. Again, you can make a link to the current account position. If AD does reduce, exports now are going to be more internationally competitive in theory with lower rates of inflation, but also lower growth. Higher unemployment means lower incomes and lower spending on imports. Or you can go down the hot money inflows route from higher interest rates that appreciate the currency, and how in that case you could see a worsening of our current account position, our trade position. But two unique elements here you can bring in as macro effects would be if interest rates are higher, you're reducing the chance of systemic risk in the economy, you're reducing the chance of bank failure, and that's spreading through the banking sector and destroying the entire banking sector. The idea is by raising interest rates, you're discouraging the amount of borrowing by businesses and by households, discouraging the amount of household and corporate debt. So overall, if household debt, corporate debt is lower, if there is more saving taking place to pay off those debts, basically you're taking some pressure out of the banking sector. Banks are not kind of waiting on lots and lots of loans to be repaid. And in that situation, there's less chance of a shock in the economy. So for example, unemployment rising or more business bankruptcy, creating more loan defaults and therefore more issues on the banking sector. You're reducing the risk of that happening and therefore reducing the chance of potential bank failure from insolvency and then systemic risk. A really unique macro effect that would be of raising interest rates. But also, going back into financial markets a little bit, by raising interest rates, you're reducing the chance of major credit bubbles and asset bubbles forming, because raising interest rates, only those who can afford to borrow will do so, only those who need to borrow will do so, whether you're a household, whether you're a business, right? So overall, the amount of borrowing taking place will be less. Those who do borrow, it's going to be sustainable households, sustainable businesses. Those who can afford to borrow, that will be borrowing. So overall, the amount of lending, the amount of borrowing taking place will be more sustainable. So in that sense, you're not going to see excessive borrowing to fund consumption, so much borrowing on credit cards to fund consumption or taking out loans for general consumption, less of that. You won't see so much borrowing that's going to be poured into asset markets like the housing market. And that's good because then you don't get a bubble. You don't get an unsustainable rise in prices of assets. You don't get unsustainable amount of credit to fund consumption and investment taking place. The concerns with bubbles is that they're unsustainable. When they burst, you see a crash in those markets that could then be very recessionary for an economy. So raising interest rates takes away the chance of those bubbles forming and then a greater risk of recession in the economy as a result. Very useful and unique macro effect right there. On the micro side, just go the reverse of what we said for expansionary monetary policy. You raise interest rates, the positive impact on savers, the potential fall in house prices and potential concerns there for those who have houses, but benefits for those who want to access the housing market. How for those who have got, firms who have got loans with variable interest rates, how it could increase their cost of production if interest rates rise and hurt their profitability. And for the indebted households, repaying loans that they have with higher variable interest rates could dramatically hurt their living standards, reduce their disposable income, increase their monthly repayments in that sense, which is not a good thing for them and could actually drive them to bankruptcy and with their assets potentially being taken away from them in that situation. So unique micro effects, as we've mentioned already. Let's now move to the fiscal policy side, shall we? We'll take expansionary fiscal policy. That means increasing government spending, cuts to taxation, running a budget deficit as a demand side policy, very much to increase AD again. Well, the macro effects take care of themselves from your higher aggregate demand. You can look at higher short-term growth, a reduction in cyclical unemployment, higher demand pull inflation, all from higher AD. But also you can worry about higher current account deficits, a worsening current account position as higher inflation could erode export competitiveness and reduce export revenues, but also higher growth, lower unemployment, increasing incomes, increasing import expenditure. That's your link there. But also with expansionary fiscal policy, you can very much isolate the government finances impact as a key macro effect. Rising budget deficits, worsening national debts from higher G, from lower T, and the long-term implications of that, burdening future generations. What about the micro effects? Well, on the micro side, you can very much go into the crowding out effect because that effect takes place in the loanable funds market. That's a micro market. So that would count as a micro effect when you dive into that market carefully and explain the crowding out effect. But also increasing government spending on education, on healthcare, on infrastructure could well be solving key market failures, improving allocative efficiency in those areas. We know the positive externalities to education, to healthcare. We know infrastructure, many types, are public goods. So that's how you can go into that argument, a good argument. Improving allocative efficiency there. More simply, just dive into public services uniquely, individually, and talk about the beneficial impact if you spend more on education. Does that mean smaller class sizes? Does that mean it's easier to recruit teachers, increasing teacher training, increasing teacher quality? It's a micro effect, isn't it? Improvements in education. Does it mean fringe education services are provided? So if you need special education needs, you get it. If you want to study subjects that are maybe outside the core curriculum, you're able to do it. So the improved quality of education there is a micro effect. Same with healthcare. You know, more spending on healthcare, does that mean lower waiting times at A&E? Lower waiting times to see your doctor? Does that mean key surgeries can be performed quickly? Again, better quality of healthcare, more people accessing beds in hospital. Go into the micro impacts of greater spending on health. Same thing if there's more government spending on public transport. Go into the micro impacts of that, no problem at all. The concerns, though, of inefficiency of government spending, very much a micro effect, isn't it? Wasteful government spending, given the lack of profit motive. The opportunity cost arguments of that are very strong. And also potential profits for firms of tax cuts, indirect tax cuts like VAT cuts and others, but also direct tax cuts like corporation tax will increase retained profits. So you can go there as a micro impact on firms. What about the contractionary fiscal policy side? Well, essentially, this is the reverse, but again, some more novel ways to think about this. So we're thinking cuts to government spending and increases in taxation, maybe to reduce AD, there is a link there, but primarily to improve the state of government finances. So with your macro effects, I would go there primarily, right? And how there are benefits to reductions in budget deficits, to reductions in the national debt, maybe even running a budget surplus in the process, and how with more confidence in the state of government finances over time, coupon rates on government bonds come down. It's cheaper, easier for governments to borrow over time with better credit ratings, but also how FDI could be promoted with stronger, more sustainable government finances. And also with better government finances, lower budget deficits, lower national debt, there is going to be fiscal space, fiscal headroom to fund expansionary fiscal policy for the next recession. So I'd weigh that up as a major macro effect. That's really why these policies tend to be used. But of course, you can go down the AD route, again, to maybe reduce demand pull inflation by reducing AD, to improve a current account deficit as an expenditure reducing policy, reducing AD, reducing inflation, better export competitiveness, lower growth, higher unemployment, lower incomes, less spending on imports, definitely. As major macro effect concerns, if these policies do reduce AD, it can mean lower growth, short-term growth. It can mean higher cyclical unemployment if it takes an economy back into recession, but also something else to make reference to, lower government spending on healthcare, education, infrastructure. These are all major LRES determinants. So by cutting spending there, you've got productive capacity constraints. Also, if you're raising income tax, corporation tax, you can constrain the productive capacity of the economy by reducing investment, reducing productivity. So nice macro effects for sure. On the micro side, well, again, we can go back into similar points we said for expansionary fiscal. So the crowding out effect, now a less chance of crowding out of the private sector, go into the loanable funds market again and explain why with less government spending taking place. You can talk about now less chance of exit inefficiency, lower G, less wasteful government spending, lower opportunity cost as a result. You can worry though about the public services impact now, lower G on education, lower G on healthcare, lower G on public transport, the concerns, the individual impact on those public services and how bad it can be for people who rely on those services. And higher inequality. If inequality is in the micro side of your course, then you can mention that as a micro effect by cutting G on education, health, cutting G on welfare, but also raising regressive taxes that could actually widen income inequality. If that's not in the micro part of your course, if it's in the macro side, well, that'll be a macro effect. So there you go, guys. That's how you look at the macro effects of these key demand side policies. Who knows, that could be a major question this year, in which case you're nicely prepped. But as I said at the start, check out all my other macro effects videos already on the channel in my paper 3 playlist, and you'll be absolutely set. Just keep this ticking over and you're good to go. Stay tuned for more videos to help you. They're coming very soon. I'll see you in those videos, guys. Thanks for watching.